All right, good morning. This is the financial fiduciary duties of nonprofits presented by the stakeholders. And today we have two presenters, Stephen Martini and Alan Alexander. And the first speaker today will be Mr. Martini. He is the Chief Financial Officer of the Hedgeman Law Firm, and he has extensive background in finance, risk management, and corporate and nonprofit compliance. He does internal and external audits and corporate and nonprofit governance in his consulting firm, and he is well versed on compliance with the New York State Public Authorities Law and the New York State Not-for-Profit Corporation Law. So Steve, I'd like to turn it over to you to begin today's presentation.
Hello, everyone. Thanks for being here. And hopefully what Alan and I will be going over will be educational and things that you can utilize for yourself. Just to start off briefly, nonprofit accounting and financial reporting is designed so that donors, the government, and other stakeholders can see how monies are spent in pursuit of the mission and goals of your nonprofit organization. The board of directors is financially responsible for the organization's stakeholders in the community that they serve. That's key, is the board now is financially responsible. The Nonprofit Revitalization Act changed the responsibilities where you can no longer be on a board and just sign off on financials without actually looking at them, and no consequences or accountability whatsoever as to how the monies are actually being spent. So the board's role is single focused in overseeing the thoughtful use of resources in support of the mission and goal. Not every board member needs to be a financial wizard. However, every board of director needs to be financially awake. Next slide, please. So I have come up with 3 essential financial reports that are the most important. There are many other financial reports that you can utilize and produce, but these are the 3 that I feel are most important. Next slide, please. So the first statement is statement of activities. This shows the revenue, expenses, and surplus or loss for a period of time. What comes in, what goes out, and what stays is pretty much the mentality of what this statement is showing. It is the revenue minus expenses equals change in net assets. In the for-profit world, the statement of activities is known as your income statement, or P&L, which most people have heard of that. So when you think of statement of activities, you're thinking, excuse me, revenues, expenses, and hopefully a surplus, but also deficit. Next, please. Second important statement is a statement of financial position. What this is it just takes a snapshot of your financial strength that the organization is in at a particular moment in time. Normally, this is reported at the end of the year, so you can show and see what the organization, did for that time period. So snapshot, meaning it's like taking a picture today, but a month from now, 2 days from now, when things change, that snapshot is no longer the same. So when you think of the financial position statement, it's a snapshot. That's good for that particular day. But if things change tomorrow, then that same snapshot is no longer valid. Now you have to take a different snapshot. So in the for-profit world, the statement of financial position is also known as your balance sheet. This is where your assets equals liabilities plus net assets. So assets are what the organization owns. Liabilities are what the organization owes others. And net assets is what the organization is worth. Normally, that would be considered the shareholders, but since it's a nonprofit, you don't have really owner equity. Third statement is the statement of cash flows. This shows all the funds flowing in and out of an organization during a period of time. Cash in the bank that's needed to pay the bills is pretty much what your cash flows is. Do we have enough cash to pay upcoming bills for the near future? The mentality here for statement of cash flows is what comes in, what goes out, and what's left over to spend, meaning what do we have to pay our bills going forward? So monthly, or this can be yearly, it's whatever beginning cash you have, plus any cash in, minus any cash out, meaning any revenue that you got in during that month or that year, minus whatever expenses that you had, that's your cash out, equals whatever ending cash you have in the bank that you have to spend. Now, out of the three statements, I believe that the statement of cash flows is the most important one. Now, most boards will give you the first two. They sometimes will not produce or hand out for your board meetings a statement of cash flows. So you need to ask for that if you're not given that statement prior to whatever board meeting you have coming up. And you're going to start seeing why the statement of cash flows is the most important, especially during COVID. This was pre-COVID, but COVID has really made this even more important. Next, please. So first, we're going to talk about budgets. Most organizations are, it's budget, we need to budget this, it's all about the budgets. So what the board of directors do, are they assure that the budgets are in place and that they reflect the financial realities that the organization faces. The board also has to assure that the budget is congruent with and advances the organization's missions and goals. Approving the annual budget is a major responsibility of the board of directors. I can't stress that enough. The budget creates the framework for any programs that the organization will be doing throughout the year and overall administrative decisions that are needed or come up during the course of day-to-day business. Next, please. Budgets deal with being able to secure the necessary funding that is going to be used for the numbers that you are budgeting for. If the numbers aren't close to what they should be that you are putting in as budgeted numbers, then your budget is not going to work. So you have to make sure that whatever funding you have that you are budgeting for different lines in your budget are close to real numbers. The board should examine the financial statements regularly. So whenever you have your board meetings, when they produce the financial statements, you should be examining them. You should compare any budgeted to actual figures in order to see and verify that the organization is keeping on track throughout the year. So that, whatever you budgeted for, the figures are backing up what you had said and you had agreed upon for the annual budget. Now, this is very important. The board should question any major variances and take corrective action if necessary. So here, if you have been monitoring the financial statements throughout the course of the year and you start seeing, well, last month, this expenditure was X, and then now it went up dramatically. Why is this? Okay, so that's an example of monitoring and then asking questions as to why. It could be a very explainable reason. Well, this payment was due on a loan or whatever it could be, but at least you know, okay, this is the reason why there was a variance in these numbers. And then also budgets will show where income will come from and how to invest resources over a period of time. All right, next. Cash flow forecasting. The main goal for cash flow forecasting is to assist with managing liquidity within an organization and ensuring that it has the necessary cash to meet its obligations and avoid funding issues. Again, this goes back to the mentality of shows how much cash will come in and out of the organization in the near future. Forecasting in monthly or semi-monthly increments is how this should be done. So I've been preaching cash flow forecasting for years. And now that COVID is here and funding is at a limited, being able to forecast monthly, semi-monthly increments to see, okay, will we be able to meet our obligations if this reimbursement doesn't come in or this grant funding doesn't come in on the date that we need it to come in. So this way here, you can go through different scenarios. You can do a worst case scenario where if no funding were to come in, how much cash do we actually have and how far can we stretch it so that we don't not be able to meet our obligations. Next, please. So methods of cash flow forecasting. There's direct forecasting, and then you have indirect forecasting. So time frame for direct is the short term. I'll say 3 to 6 months would be more of a direct forecasting mentality or method, versus indirect, I would say that's 6 months to a year, 2 years, 3 years. But just think of indirect as being a longer term time horizon. So direct forecasting is, what should it show? The cash that's required to fund any working capital over the next 3 to 6 months, so that you are able to forecast, can we pay our bills in the short term? For the long term or indirect forecasting, it's going to show the cash required to fund longer term growth strategies and capital projects. So if you have a construction project going on and you're a nonprofit for, like if you're Habitat for Humanity, that's where will we have the funding to keep this long-term project going? Let's say it's a 2-year construction project. Will we have the funding to be able to sustain the 2 years so that there's no gaps in the project being completed? And then how's it constructed? So direct forecasting, it's an analysis of upcoming receipts, debts, payments, creditors, pretty much, again, any bills and expenses or revenues that are going to be supposed to be coming in between the next 3 to 6 months. And indirect is, your various income statements, your balance, derivations. So that's where you're going to be looking at more of the financial statements for your balance sheet, your income statement, to see, all right, do we have for forecasting for those longer term projects, will that be okay? Next. So forecasting versus budgeting. The cash flow forecasting moves beyond traditional budgeting. It can be used with or instead of a traditional budget. You can revise. The best thing about forecasting is that you can revise it however you want. You want to revise it weekly, you want to revise it monthly, quarterly, so that it's more in tune with reality as opposed to budgeting. Remember, budgeting it's a picture, it's a snapshot of that particular day that if everything goes as planned, we're going to budget money for certain things in hopes that that is what we're never going to go over budget for what we think is going to be utilized monetarily. Next. So forecasting is more agile. It's real time. So that's why I always advise my clients, and whenever I set up a financial plan for organizations, when I come in, is we'll do the traditional budgeting because you have to have that, but I also add in the forecasting and I keep tweaking it. Normally I do it every 3 months. If other or emergency situations come up, then I may have to do it, monthly, to make sure that the cash will be there. But 3 months, in my opinion, seems to be the norm, where now you get a refresh of, okay, what's the next 3 months looking like? If this revenue source doesn't come in, will we have enough? What if it doesn't? Do we have enough cash to be able to sustain until that reimbursement or that grant donor check will come in? So traditional budgets are a way of limiting spending. You say, okay, we're going to limit and say we only want $10,000 for marketing. So you're limiting what you want to spend on certain categories, certain lines. Rolling forecasts force you to keep closer track of the spending. So ongoing discussions about revenue and expenses helps the organization move more quickly when needs arise. So if you are forecasting every 3 months, you are up to speed on the revenue and expenses that should be coming in and coming up in the near future. And if something were to happen, you're on top of, okay, well, that changes things, but now we can quickly change gears and figure out how best to rectify whatever the situation is, because you are up to speed on exactly what you have now, not looking at a budget from 6 months ago. So spending less time on budgets and more time analyzing performance will benefit the organization in the long term. So I know it said 7 characteristics of a financially healthy nonprofit. I added another one, and so now it's 8. And the reason why I added another one is because in this world of COVID, with people being remote, it is become very important and crucial that that's going to be another element of being successful. So the first one is having sufficient income / cash flows to ensure stable programming. So surplus is not a dirty word. I know most people say, well, you're a nonprofit, you're not supposed to make any money, you're not supposed to make a profit. That's wrong. The money goes back into the organization. It's not like you're going to give the CEO, a $50,000 bonus, or, things that happen in the private sector. So surplus is key. In a perfect world, having sufficient income, cash flows, of course. But again, not everything is perfect, so having a surplus is key going forward. So, and realistically, having 3 to 6 months of committed expenditures in unrestricted net assets is key. But again, not everybody, that's a perfect world. So that's where the cash flow forecasting is important, where maybe you only have 1 to 2 months of committed expenditures that you have access, that you can cover. So that's where, that cash flow forecasting becomes very important. Number 2, having ready access to cash in times of need. Internal versus external sources. Next. So I've come up with a little slide to kind of pare down a lot of information into what the meanings are and what it includes. So internal sources of finance are, you know, sources of income that are generated within the business or from existing assets or activities. This includes any accumulated reserves. That's where that surplus becomes very important. Any sales of fixed assets or programming that you do, any retained earnings if you have endowment or investment funds, that's more talking about NIFA, and any debt collection that you're collecting that people owe you. Here, for internal sources, the cost of this is low. There's no collateral that's required for you to be able to get that information, to get that cash. And the amount raised, it's comparatively less than external sources, which is the other way of, do you have access to? So external sources of finance, or any external sources, that implies an arrangement of capital or funds from sources outside the business. This is your fundraising. This is any loans that you get from banks or other financial institutions, any public deposits, and that meaning any donors, that give to charities. If you have like a line of credit, that's where your external sources of finances are going to be coming from. The cost with that, though, is high because sometimes there's collateral. You have a loan from the bank or a letter of credit, they're going to have collateral. So, there's a price to pay to go outside the organizations if you need money. But the amount that you can raise is pretty good because you can get a loan for $20,000 or $50,000, where, internal sources, your accumulated reserves might only be $3,000, where maybe that only gets you through a month. All right. Next. Third is engage in income-based spending, not budget-based spending. So it's imperative to have realistic, up-to-date income and expense projections, have realistic cost of next year's service delivery in order to forecast what spending you're going to be having. And then current market conditions can change from when the budget was made. Remember, the budget is a snapshot for that particular time and period. If market conditions change, now that budget-based spending that you thought you had is no longer. Now it becomes more of an income-based spending mentality. 4, retain a positive cash balance at the end of the year. Of course, everybody would like that. It may not happen, but in a perfect world, that's what you are striving for. 5th is a positive accumulated unrestricted net assets for years when deficits do occur. So having lower negative unrestricted net assets is a concern. Now, unrestricted means you can use the money for anything that you want. Restricted means if you get donor money or grant money, it can only be used for certain things, which limits you for what you can and can't use it for. In years where a deficit does occur, it's key to have accumulated sufficient assets to cover the current deficit. That's where that surplus comes into play. But again, not everybody can build up a surplus, but that is the goal of the organization. 6, operating reserves have been established to finance growth and cash shortfalls. 7th one would be the board and management hold themselves responsible for the financial stability of the organization. That has become more and more important and key, that they are held accountable for how the organization spends their money. They can't just be spending wildly with no regard whatsoever. And the 8th one, this is the new one that I included in this, is internal controls. These are policies and procedures that protect the assets of an organization. They create reliable financial reporting. They promote compliance with the laws and regulations of New York State or whatever state that your organization is affiliated with. They achieve effective and efficient operations. What they should address are accounting and reporting policies, and the organization's communication processes, via internally that the board and staff and everybody is communicating throughout, and externally that you are communicating to your stakeholders, your donors, the community that you are involved with. Next. And they should include procedures for handling the funds received and expended by the organization, preparing appropriate and timely financial reporting to the board members and officers, conducting an annual audit of the organization's financial statements, doing staff evaluations and evaluating programs, what works, what doesn't work. If something's not working, why are we wasting financial resources in a program that doesn't work? Maybe there's a different program or a different way that we should go. Maintaining inventory records of real and personal property and their whereabouts. And then also implementing personnel policies, conflict of interest policies, and whistleblower policies. Those have become very, very important over the last decade or so. So, again, having those internal controls in place when everybody is remote, especially with deposits and people having access to writing checks, where the person who is depositing money shouldn't be the only person writing the checks, because that's how you start seeing where somebody has too much control and power. And then, okay, I'm depositing and writing the checks. There's no checks and balances. This is where this internal controls becomes very, very important, where money isn't wasted, money's not going out the door. Next. So financial governance, role of the finance committee is to review the budgets and the organization's performance compared to what they budgeted for at the beginning of the year. Ensure that the financial reports are prepared by the staff are timely and accurate. They should be able to make financial policy recommendations during the course of the year as it's going on. Report on the financial conditions to the full board of directors. So at the meetings, the finance committee should be reporting on this is what's going on, this is what these numbers sort of mean, to kind of break it down so that people who are on the board that aren't finance gurus don't need to be. Someone's explaining this is what's happening. And of course, finance committee members rock. That's like a finance joke. Only finance people kind of understand that one there. Next, please.
Steve, I'd like to add to this
Yes.
and your points as well. Generally speaking, for the organizations that have official audits by CPA firms, they're usually assessing the internal controls of the organization. And I often find with smaller organizations who don't have to absolutely have the audit done by a professional firm at that level, they're really not paying attention to internal controls. And even some organizations don't even have an internal controls policy. And this policy in particular, probably on the finance side for internal controls, is, if it's not the most important policy, maybe your bylaws are, but it's probably second to that, because it's how the organization deters fraud. And where the organization doesn't have an annual audit performed by CPAs, good governance really dictates that that organization should at least pull out the internal controls policy and make their own assessment, right? Has it been followed? So from a legal standpoint, if there were to be fraud and you're investigated from, the Attorney General's office or the Comptroller's office, whatever the case may be, they're going to want to see that the board was actually checking in on these internal controls to make sure they were being followed. I'm sure, there's plenty of examples, and the best that I've seen is sort of that little league or that volunteer fire department that has had the same treasurer for 10 years, like you said, and has, control of everything, the documents, they're making the entries, they're writing the checks, they're doing the deposits, and all of a sudden $100,000 is missing, right? Where was the board of directors while that was going on? So do you have any other tips too about the types of things the finance committee should be reviewing on a monthly basis that, kind of back up the spending? Like bank statements or things like that?
Oh, yeah. You know, everything should match. So document retention is key. There should be copies of everything so that if there are expenditures or revenue deposits coming in, there should be a backup that monitors and shows that that actually occurred, that there is something tied to that transaction. That's key, having the document retention so that if there is ever any questions that the finance committee or the board comes up with and say, hey, can you show me, who gave that money? And the finance person should be able to easily produce the backup for that expense or that deposit. If they don't have the backup, the document retention that backs up what that was, that is a red flag. That means that, what else aren't they monitoring and have for their backup for their audit purposes as well. So the audit committee, this is where you hire your outside auditors, and Kate kind of just mentioned that. They monitor their performance. They report audit results to the board. So, they just kind of go through, yes, you have internal controls, but, their role isn't to actively see, are you following your internal controls? As long as you have something in writing, it's there. Okay, we're good. That's as far as those internal auditors will go. And the role of the management and staff is the management provides leadership and direction for the organization, and the staff provides the boots on the ground and best efforts in order to complete and perform the mission and goals of the organization.
And in 2014 here in New York, the law had changed significantly in a lot of areas, but the main one was adding a very specific section on audits and audit committees and their duties, and the requirement of having an audit policy, audit committee policy. And, the going back to internal controls, a lot of questions I always get from nonprofits is, well, the audit committee and the finance committee, can they be the same? And my answer is always absolutely not, please. You can have a few members that might overlap, but the whole point of the audit committee is to sit in oversight to the organization, including the finance committee, which really is more in charge of the day-to-day. The audit committee as well got handed some additional duties in 2014 when the law changed, and that all conflicts of interest are also to be sent to the audit committee for review first and for recommendations. So, a lot of organizations too will ask, do I really need an audit committee? And the answer is, you're required by law since 2014. And clearly the legislature and the Attorney General's office put that into law because people really weren't following it. So, audit committee members, in addition to finance, have come a long way, since 2014. And, when you have an organization, like I said, that doesn't actually have to have a full-blown audit, the board's duty, I feel, there is heightened because they have to oversee, not only the financial stability of the organization, but that, the internal controls and, like you said, the document retention. You're only, if you don't have that piece of paper, it's as good as it didn't happen, so just adding to your commentary there.
Okay, no problem. So now we're going to talk about reporting. One of the forms here is IRS Form 990. What this is it's the annual reporting tax return document required to be filed by all federally tax-exempt organizations. This form is the way that the government, via the IRS, ensures the compliance of your organization and evaluates how your institution is doing financially. It's kind of, we'll say it's like the report card for your nonprofit. So this way here, the government kind of will get an idea of, well, how are you doing? And this is the way for them in order to do it, where if something were to come up, information is missing or what have you, via filling out these reporting forms, then it'll start raising some red flags where the IRS or the government will start inquiring as to, okay, well, what's going on with this organization? So it's a good way for them to monitor. And I believe it's important to maintain the integrity of the organization. So most tax-exempt organizations are required to file a 990 annual return. Which form an organization must file generally depends on its financial activity. So a organization that has gross receipts less than or equal to $50,000, you can file a 990N e-postcard. You can choose to file a full return, but you don't have to. You can just file a postcard and you're good to go. Receipts greater than $200,000 a year and total assets at the end of the year is less than $500,000, you can file the 990 EZ form, or you can file the full 990. You have an option there. Gross receipts that are greater than 200,000, or total assets at the end of the tax year that's greater than $500,000, then you have to file the 990. And then if you have a private foundation, regardless of whatever the financial status is, less than 50,000, 200,000 to $500,000, you file a 990 PF. Next.
What's also important to note too with the 990s is another change in the law in 2014 was that the entire board must review and approve the filing by resolution of the IRS Form 990. A lot of times, if the nonprofit has an auditor, a best practice, of course, is to have the auditor come in and present the 990 and the audited financials to the board so that, they've been informed of what is actually in those documents. A lot of board members still don't realize that their name and their address and other information is in there about governance, and that if there's ever any issue, the liability remains on the board of directors. So I always ask my clients, if there's an auditor that's doing the audit, to have them come in and present and to really walk through the 990 with the board, because if the law is going to require the board approve it, they should at least have a minimum cursory understanding of what's in there. And the other piece too about the 990 really is filing it and timely. If you're late, it can cause issues, for the organization as well.
All right, so who is not required to file the Form 990 or 990 EZ? Certain religious organizations, churches, schools below the college level that are affiliated with a church or operated by a religious order, certain governmental organizations, certain political organizations, certain organizations with limited gross receipts, less than the 50,000, you can just file the postcard. You don't have to do a 990 or 990 EZ. You can if you want. certain organizations that file different kinds of annual information. Remember, we had talked about at the bottom of that last slide, the private foundations, they file a 990-PF. So I'm not going to get into all the specifics of what political organizations can, what governmental ones, there's, that's all on the website for the 990 if you need more specific information on that. So key, who signs your Form 990? It's a current officer of the organization. So it can be the president, vice president, treasurer, CFO, or your accounting officer if you don't have a CFO, and a tax officer needs to sign. Now, the next annual financial report that's very, very important is the CHAR 500. This is the annual filing for charitable organizations. Under New York state law, charity is defined very broadly and includes purposes such as education, relief of poverty, cultural programs, promotion of health and research to cure disease. And then there's many other purposes that are but they have to be beneficial to the community. All right, these are just a few examples of what a charity means under New York state law. Next. Most organizations that hold property of any kind for charitable purposes or engage in charitable activities in New York State and/or solicit charitable contributions, including grants from foundations and government grants in New York State, are required to register with the Attorney General's Charities Bureau. Organizations that are required to register with the Attorney General's Charities Bureau must annually file the Form CHAR 500. Next. Organization registration categories for the CHAR 500. It's kind of like with the 990, the postcard, the EZ, the PF. For the CHAR, you have a 7A, which is solicitation and collection of funds for charitable purposes. That's what most of the charitable organizations will fall under, will be a 7A. There's an EPTL, which deals with the state's powers and trust law. You have a dual, which is you register under both the 7A and the EPTL. And then the fourth registration category would be you're exempt. Your organization is not required to file. And the next slide, I believe, will go through exempt from CHAR 500 registration. These could be any religious organizations, houses of worship, other charitable organizations run by religious organizations, membership organizations that do not solicit from the public. Just they solicit or they get from their membership only, not from outside or from the public. The PTA, the Parent Teachers Associations. Any educational institutions that file annual reports with the New York State Department of Education are exempt. And governmental agencies are exempt as well. Who signs your CHAR 500? Now, with the 990, you just had to have one of an officer of your organization. For the CHAR 500, requires two signatures. One is the organization's president or other authorized officer. And then the second one is the CFO, treasurer, or other person with fiscal responsibility. So your accounting officer, if you don't have a CFO. So that's the difference here is the CHAR, you have to have two signatures, mainly because when you're dealing with charitable contributions and the monies, the finance person who is reporting all this and, transactions and everything for your financial statements, they are making sure that whoever is doing all that accounting work, you're signing this as well, that what you are saying, what you did, deposits, expenditures, where the money is going for your organization is correct. This concludes my part of this presentation. The next sections will be from Alan Alexander, and he will be talking about and discussing banking for nonprofits. So stay tuned.
Thanks, Steve. Just one, I guess, final point on policies as well for the financial piece that the board really should have from a legal perspective. Not only should you have a governing financial policy that addresses, check writing, depositing, receipts, perhaps even how money is spent. If you are a nonprofit that also has investments, you certainly need an investment policy and to comply with the New York State Prudent Investment Act, which we actually have our next session next month is coming up on that. There's so much detail to endowments and funds that are invested and the governance that's required by the board of directors. It had to be separated out into a separate presentation so that we could present the material in a better organized fashion without overwhelming you with not only the financial piece here, but also the banking piece. Internal controls policies as a definite. Steve also mentioned document retention policies. That's extremely important as well. And if you haven't updated your document retention policy in the ages, it really should conform to include e-documents as well, because a lot of documents these days are stored digitally for that. So without further ado, I am going to introduce our next speaker, Alan Alexander, who is the Vice President and Senior Commercial Banking Relationship Manager at NBT. He's worked in the banking industry since 1993 and has over 24 years of commercial banking experience. He is involved in the community at all different levels for board service and otherwise. And I think he's going to explain too how lending and banking has changed during COVID as part of all of this. Lending and banking have become extremely important because, as Steve mentioned, cash management and cash flow are really crucial to an organization. And when something like COVID, like a pandemic, happens, I think, it creates a lot of financial uncertainty and sustainability issues for nonprofits. And Alan will talk a little bit about how, banking and lending can help with that in the short term, but also, positioning your organization in good financial health to obtain a loan if that's something you need to do. So Alan, thank you for joining us, and I will turn it over to you.
Thank you, Kate. Good morning, everyone. So part of the topics we'll cover today on banking for nonprofits includes the following: how to analyze how banks look at nonprofits. We'll go through the 5 C's of credit, the characteristics of a healthy nonprofit in the eyes of a bank, the benefits of using lines of credit, borrowing during the COVID-19 pandemic, what financial statements are necessary and important in terms of dealing with your bank, as well as bank covenants and loan agreements. And finally, we'll talk about cash management services that are provided by banks and why they are important to deter fraud protection. Next slide, please. So when a bank analyzes a borrower, whether it be a for-profit entity or a nonprofit entity, there's 5 characteristics that they look for in a borrower. They are character, capacity, capital, conditions, and collateral. Character is pretty self-evident. They're looking for trustworthy and reliable borrowers. So they're going to assess the organization as a borrower, its credit history, how has its debt obligations been handled in the past. These are all important characteristics of a nonprofit organization. They're going to look at capacity. What is the organization's level of cash flow? and its ability to repay its debt obligations. They're going to pay attention to the capital that a nonprofit has access to. What level of debt has it assumed in the past? What are its net assets? Its surplus equity position. Steve talked about how important surpluses are. This is why. The banks can look at if you have a net surplus position of equity in the organization. The fourth item is conditions. The bank's going to ask you, how do you intend to use the loan funds we're going to provide? What's the size of the loan? What are the current market conditions? Obviously, with COVID-19, the conditions have changed from pre-COVID days. And it is currently evolving as we go, hopefully, into recovery from COVID-19 and the pandemic. Final piece is collateral. What assets could the nonprofit pledge to secure the loan by the bank? So these are the five, what we call the 5 C's of credit that banks look at in assessing the strength of a borrower. What are some of the characteristics of a healthy nonprofit? Well, for the bank, they're more likely to lend money if the nonprofit can demonstrate the following. It has adequate internal cash flow to repay its debt obligations. Very succinctly and simply, is the cash that it brings in enough to cover its principal and interest payments of its debt obligations? A target that the bank will normally look at is a 1.20 times coverage. That is, does the nonprofit accumulate, generate enough cash to cover its principal and interest by 1.2 times? The coverage can be defined as change in net assets, Steve talked about earlier, plus depreciation and amortization, plus interest that is paid by the nonprofit, minus any distributions that are given. Most cases, nonprofits don't take distributions. These are more of a for-profit issue. It's then divided by principal plus interest. The bank's going to look and see, does the nonprofit have sufficient collateral to secure the debt? Now, unlike manufacturing companies or for-profit entities, most nonprofits do not have huge amounts of real estate, huge amounts of accounts receivable, or huge amounts of inventory, or even equipment like you would have in a manufacturing type of entity. But what a nonprofit may have might be, it may own the building it's in. It may have excess funds in the form of marketable securities. It may take a life insurance policy on some of its executive directors or other important members that there's cash value. All of these can be used as collateral to lend against.
Hey, Alan, I have a question for you.
Sure.
With, COVID or, any, I don't know what you would call it, upset to market conditions, but, we've all been dealing with COVID. So I think that's the best example. And as an attorney, I get a lot of calls from clients about, the different programs that are out there. But, historically, an organization might have been limping along before COVID, right? And now it's even worse. To what extent is the historical performance of the organization, let's say over the last 2 or 3 years, taken into consideration? Because maybe they've lost 80% of their program revenue, right? But they figure, 8 months from now, they'll be in a much stronger position and they just need, either a short-term credit or a loan to get by. Does the bank, or will the bank, look at historic performance?
Sure. I mean, the banks can look at historic performance, current performance, and forecasted performance. There's three factors that we'll look at. Historical is important because you want to know what has the organization historically been able to achieve over the past 2 to 3 years. They're going to look at current interim numbers for the current year because that'll capture what is the current lending environment. With this, we have COVID-19, we have the pandemic, we have there could be other issues that each not-for-profit individually may have. That's going to be determined as well. And also, it'll look at the future forecasts. As Steve mentioned, the cash flow forecasts are very important, especially over the next year, and that's what they're going to look at.
A lot of times I will get calls too that, talk about liability, and, some of the board members believe taking out a loan, to keep the organization moving forward might be the best thing to do, while other board members are really concerned about that because they feel that, things are so uncertain that they don't know if they'll be able to pay it in the future. And they'll ask me, what is our legal liability as a board of directors if, we've made a bad decision of obtaining this line of credit or this loan, knowing that we may not be able to pay it back. And, that's always a pretty serious discussion. And I have some background myself in commercial lending, but I think from a board of directors position in approving a borrowing resolution, you would have to be, and I always ask, how on top of the financial statements are they? Do they have that cash flow projection that, Steve mentioned? And, even in COVID, that might be not a great projection at all. So, I guess in your professional opinion, what are some of the other items the board should look at before deciding to pass a borrowing resolution?
Well, if there's two things here. How great is the cash need of the organization? If you need the loan to survive, you got to ask yourself, is it better to fold up the tent, or is it better to go into debt to survive? If it's a timing issue, if you need the borrowings and the debt from a timing perspective to get you over the hump 3, 4, 6 months, a year from now, and you know that there's cash coming in at the end of that period to help pay things down, it's just going to get you from a timing perspective from point A to point B, that's probably what you need this for. If you are taking a grant, either it's a federal or state grant, they may require a certain amount of expenditures. And in order to fund those expenditures, you may have to borrow. Just be careful. When that happens, you please be sure that when the reimbursement funds come in, use that to pay down your debt. Otherwise, you could grow debt. Finally, you have to look at it. If you're going to have debt that puts you into a negative equity position, it may be necessary to do so, but you should try to limit it so that there's light at the end of the tunnel, that you can eventually, within a year or two, get back to a positive equity position by paying down the debt. So I would recommend, getting into a debt facility that is manageable and you should be able to pay it back with 6 months of cash proceeds. That should be a good target. If you have that and can do it, then you probably should be able to take on a debt facility. But remember, there's a lot of different reasons for why you need debt. It could be for timing. You may have to purchase a building. You may have a bunch of marketables of investments that you want to pledge just so you can finance a campaign that you know is going to bring in enough money to pay off the loan pretty quickly. So it really depends on what is the need and how quickly can you recoup the cash to pay off the loan. Hopefully you'll be able to pay it off within a 3 to 5 year period. That brings us to the next slide here, which is a line of credit, which I feel can be a lifeblood to nonprofits. In its normal life cycle, a nonprofit will typically take on a line of credit from a bank. The line of credit, in simple terms, is used to fund the timing differences. It's to fund the day-to-day operations of the bank, of the nonprofit, and it is used to assuage any cash flow timing issues. Some people call it the lifeblood of a nonprofit. I don't know if that's 100% accurate, but it is necessary, as it does help nonprofits deal with the timing issues it will face. Term loans are a little different animal. It's typically used to purchase capital expenditures, whether it's a building, furniture and fixtures, equipment, etc., for the nonprofit. Next slide, please. There's a couple types of lines of credit that a nonprofit may be faced with. One is called a revolving line of credit. This is an interest-only facility. Funds can be drawn from this line of credit anytime if funds are available on the line. So if you have a 500,000 line of credit and you have 100,000 outstanding, you have 400,000 available. Again, it's interest only. You don't pay any principal, they will interest only. So if you don't pay down the line of credit, it could grow if you're just paying interest. My recommendation is set aside some of your cash that you forecasted to pay down not just interest, but the principal on the line when you can. Then there are line of credits that are secured by pledges. These are typically campaign-based programs, usually to fund a capital project or a campaign program. The advances or draws on these lines of credit are based upon the targets or budgets for a specific campaign or program. The paydowns from the line come from cash pledges that are received from a capital campaign or from restricted assets, specific restricted assets that are earmarked for the specific campaign or project. So these are more campaign or project driven lines of credit. Next slide. Sometimes lines of credit are required by grants that you may receive as a not-for-profit from federal or state agencies. As I mentioned before, the important and critical thing is you must be sure to apply your grant reimbursement proceeds to pay down the balance on the line of credit that was used to front expenses required by the grant. Otherwise, you can grow a line of credit balance pretty quickly. As I mentioned before, they are interest only. So they will require discipline from your finance team, the treasurer, the finance committee, to ensure that you're paying some principal, if you can, on the lines of credit. I've always found term loans are better for not-for-profits. If you can get a term loan, get that cash up front, get on a scheduled principal and interest payment program, it's better for the not-for-profit. You're continuously reducing your exposure to the debt, making payments, and they're scheduled and laid out for you so you can cash flow forecast better. With respect to if you have excess funds that come in, apply them to your loans. As a banker, we appreciate that. It'll free up capital, it'll free up cash, and it'll reduce your interest expense going forward. As you mentioned before, a best practice is to have at least 6 months of your nonprofit's cash requirements available as funds on your line of credit. This is the emergency reserve fund that we talked about to cover timing differences. Kate mentioned the COVID-19 pandemic. We know it has dramatically and severely impacted many of the businesses in the capital region, and it has really impacted not-for-profits. The reason is this: many of our for-profit entities that we've seen have qualified for federal or state stimulus packages, such as PPP, EID, and New York Forward. These are all government-sponsored loan or stimulus packages. Many not-for-profits did not qualify for PPP funds or even some EID funds in round one in 2020. Now in 2021, finally, we are seeing some nonprofits beginning to receive these funds, although they are still in a measured amount. It's important to know if you got PPP funds, you can apply for forgiveness. Other type of stimulus packages are actually loans. You got to treat them as debt. They are not going to be forgiven. So be careful what you receive. You have to, when you deal with the SBA, the Small Business Administration, read the fine print. Go to their website, have your CPA or your attorney review what's on there. You do not want to get into a situation where you borrow something you can't pay back. And if the government's coming after you, it's even worse than a bank coming after you, just to give you a warning. PPP, hopefully you use the money as a non-for-profit to spend on salary and those expenses that are agreed upon by the SBA to be fully forgiven. If so, you should be forgiven. We've already seen some small borrowers be forgiven in entirety of the round one PPP money. Then there's regular bank loans. The banks are going to be more careful in COVID than they were pre-COVID. However, they're going to understand that a lot of borrowers will be looking a little bit better because of PPP funds received. Now, for not-for-profits, it's going to be harder because Most not-for-profits, their number one fundraising campaign are large events, whether it's a large golf outing, a gala, a huge dinner. These have been the tried and proven fundraising packages and programs that non-for-profits have successfully used to drive revenue and cash. In the COVID-19 pandemic, these have gone away. And that has hurt non-for-profits because their revenue stream has dropped considerably. It becomes more important when you're dealing with the bank that you calculate and have your finance team measure that you have enough internal cash flow to service the required debt payments that before your nonprofit should ever consider dealing with the bank to take out a loan. This is doubly true in the COVID-19 pandemic environment.
Alan, just the PPP forgiveness, this is where the document retentions that I was talking about earlier is key, because you need to have the backup in the show when you hand in your packet for forgiveness. You have the backup that shows exactly what the money was spent for. And then in order to get the forgiveness, you have to, make sure that you meet the percentages that are the guidelines for the forgiveness for the loan. So that's where, your accounting team, the finance committee really needs to be on their game, on top of, what they're spending it on, the backup, and to be able to classify in whatever financial software system that they're using that that these funds were designated for the PPP and this is what they were used for.
Yeah, exactly. In this environment, having a good handle on your bank statements, your payroll, your W-2s, and your internal reporting is critical, because the government, the SBA, will bounce back stuff and not prove either your funding or forgiveness if it doesn't have all the information. I would recommend, as a non-for-profit, work closely with your attorneys, CPAs, and bankers. They should be your triumvirate team to deal with this sort of thing. And they're going to be your advisors during the situation. As a non-for-profit, you need a good attorney, you need a good CPA, and you need a good bank. Those are three important advisors and team members you should have externally. With respect to financial statements, most banks will make their primary lending decision based upon a non-for-profit's financial performance as evidenced in their financial statements. Typically, the bare minimum statement, as Steve mentioned, is the tax return of the non-for-profit, or the 990. We're also going to want to see an annual report that the nonprofit provides that provides critical information and background on the programs that the not-for-profit is running. Were the programs successful? How was your fundraising campaign? How long is the campaign? What are the pledged funds? These are also all important information that has to be provided if you're looking to get lending from a bank. So as you get larger as a non-for-profit, reviewed financial statements are very important tools that banks look at. They're the middle ground. They're stronger and more exhaustive and inclusive and comprehensive than a tax return, but less than an audit. The audited financials provide the highest level of comfort for the banks. They're the most costly for a not-for-profit, no question. They're the most stringent, require the most control, and they have the highest cost, because your CPA firm is going to be spending a lot of time with the not-for-profit going through all of your records. We've seen that these are necessary, though, if there's state or federal grants involved. If you are getting a grant, they're going to want, the body that issues the grant is going to want audited financial statements. Just a heads up. Most banks are typically going to require 3 years of financial information, as well as your current budget, and as Steve mentioned, your cash forecast. They're going to want to see all three. Okay. With a loan, if you do enter a loan with the bank as a not-for-profit, more than likely the loan is going to have some requirement or covenant, which is basically a legal documentation, which is your loan agreement, or credit agreement it's called. It's that bank legal documentation they provide you when you have a loan that sets the defined terms and conditions of the loan between the bank and you as a not-for-profit. Financial covenants are instituted by banks to set a target for a specific level of performance for the non-for-profit. The finance committee, treasurer, or your board all must review the financial covenants at least once a year. And this should be done more than once a year by the treasurer or CFO of the organization. It's important. If you don't comply with the bank's covenants, it could lead to bank penalties, fees, higher interest rate, or loss of a line of credit borrowing privilege for the not-for-profit. Again, this is something your finance committee should be reviewing. When I mention this, that's why I said you should be in close contact with your banker, your attorney, and your CPA. All three will help you manage the covenants. If you get audited or reviewed financial statements, the CPA is going to put in the footnotes if you are in compliance with your financial covenants or not. Just one more thing to think about as a not-for-profit. Next slide. The final piece of it is, we talked about the lending side and how important it is for some not-for-profits from a cash flow injection standpoint. But we're seeing a lot of not-for-profits fail in one category, and that is cash management and fraud prevention. Most banks will have a cash management system, which will help a for-profit or non-for-profit deal with the handling and management of its day-to-day cash needs. The bank will provide this via a treasury system, and maybe it's online banking system, or maybe it's whatever each bank calls their online banking. It's their online banking system for small businesses and not-for-profits. The board's finance committee and treasurer should review the organization's cash management banking services periodically to ensure that they're adequate for the size and scope of the organization. It may be what you have in place was good and sufficient when the non-for-profit was smaller. But now as a non-for-profit grows, its assets grow, its budget grows, its cash needs grow. You may have to upgrade your cash management services. Speak to your banker about doing so. The cost goes up on a monthly basis for some of these cash management needs, but what the products you get may be more in line with what your needs are now than they were years ago. So have your board do this. Have your board review what's going on, or at least your finance committee, which reports to the board. It has to happen periodically. Second piece of this, where a lot of non-for-profits are lacking, is fraud prevention. Most banks provide fraud prevention services as part of their cash management product. This is crucial. I can tell you as an experienced lender that the fraud that is out there is rampant and it's getting worse. COVID-19 has made people who once had money poor or struggling. And instead of fighting through it, they're cooking up these schemes to steal your money or the not-for-profit's money. We all get these messages every day to extend your car warranty on your cell phone, or you get emails from whomever saying, from funds. These are all scams. As a banker, I'm seeing every day that our clients and non-for-profits are getting scammed and money is getting taken from them. So most banks do offer fraud protection. Two of the things I think you should ask your board, if you're on a board, or your finance committee of your non-for-profit is, do we have positive pay and do we have ACH debit block? Positive pay is protection against check fraud. Basically, your CFO or your bookkeeper or your controller for the not-for-profit will send a check file whenever you do a check run to the bank that lists all the checks that are going to be presented. The bank takes that list and compares it to the checks that are deposited or presented for clearing. If something pops up that doesn't match, they call you to confirm. That prevents fraud, because a lot of times the fraud is done unbeknownst to the organization, and somebody comes in with a check and cashes it in at a bank. Once that money is cashed, it's very difficult to get the money back. It can happen, but it's very difficult. The second instrument is an ACH debit block. This is even more critical in a modern age. Most people have your ACH withdrawal set up on their not-for-profit account. Typically, it's your payroll, whether it's paychecks, whether it's ADP, they're pulling money out at payroll. It could be your utility bill. It could be your cleaning service. It could be your coffee service, whatever the not-for-profit has. Those are usually withdrawn from your account by an ACH. The way this works with the bank is your treasurer or your CFO or bookkeeper or controller will send a file to the bank that says, here are all the pre-authorized people or entities that can withdraw funds via ACH from our nonprofit checking account. If what gets pulled out of the account or attempted to get pulled out of the account doesn't match that list, the bank won't withdraw those funds. So this catches those entities that are trying to defraud the non-for-profit by pulling funds out via ACH. And the thing with ACH, once the money leaves your account, it's gone. Okay, it's not like a check we can track down. ACH, typically, it's gone. So this is an important thing, especially if you're on a board of a not-for-profit. You should ask, hey, do we have anything that comes out of our operating account via ACH? Do we have protection, like a debit block against that? Asking them for the palliative pay as well. These are important questions as a board member. You should be asking your finance committee and your executive director and treasurer. Next, Kate.
I think that's the
I
last
think
slide.
that's it. So
Yeah.
that's the end of the presentation.
All right. Well, thank you, Alan and Steve. We really appreciate you being our guest speakers today. Our next session coming up for the Stakeholders Board Institute in March is on NIPMIFA, which is the New York Model Prudent Investment Act discussion, which will center around the board's duties and governance in connection with invested funds and endowments. There's a lot of requirements that NIPMIFA places upon the board of directors in managing those funds. So that will also be a really important session, part 2 to this session next month. And hopefully we will see you then. Thanks all.